In this podcast, you will learn the basics of accounting. The 5 basic accounts of accounting are assets, liabilities, equity, income, and expenses. Assets are the things that company own. Liabilities are the opposite of assets, which are the things that your company owe. Equity is the overall net worth. Income is how much the value of the account increases, and the expenses is the opposite, which is how much the value of your accounts decreases. There are 3 types of financial statements: the balance sheet, income statement, and cash flow statement. It is a formal record of the financial activities of a business or other entities. It is to provide information about the financial position, performances, and changes of an enterprise. Income statement. On the left-hand side of the picture, an income statement is shown. It is a financial statement that shows a company's financial state over a specific period, usually over a quarter of a year or a year. It gives a summary according to its revenues and expenses. Revenues are stated before the expenses. Revenues is the amount of the company has sold or earned during that specific time period. On the other hand, expenses is how much money the company spent on. On the right-hand side of this picture, a balance sheet is shown. It is also a financial statement that shows the current condition of the business in terms of its assets and liabilities. The basic formatting of the balance sheet is set up with 2 columns. The left side of the balance sheet states the assets of the company, and the right side of the balance sheet states the liabilities and the owner's equity. The assets include items such as cash, inventories, and accounts receivable, which are amounts that are owed to the company by the customers. On the other hand, the liabilities include bank indebtedness and accounts payable, which are amounts owing to the creditors. The most important concept of the balance sheet is that the outcome, which is the total assets, must equal to the total liabilities added with the owner's equity. Also, to show the importance of this amount, it must be double underlined. The relationship between net income and equity is that when one increases, the other also increases. For example, if your company earns more money, the values of your shares in the company will also increase, which means you're making a profit, earning more money. The relationship between revenues, assets, and equity is that revenue is the amount the company has sold or earned, as I have mentioned previously. If that amount increases, your assets will also increase because you are making a profit, therefore owning more money. When your assets increase, your equity will also increase because this is the form of earning money, and the value of your shares will increase. The last relationship that I am going to talk about is between expenses, assets, liabilities, and equity. If the expenses increase, that means you're spending more money. Your assets will therefore decrease, which is your bank or cash. When the assets decrease, your liabilities will decrease because the amount of your money you owe will grow. When your assets decrease or when your liabilities increase, your equity will follow your assets and decrease because more money is used from the company, so your shares of the company will be less. Net profit is also known as the net income. It is the company's total earnings. It is calculated using the total revenue of the enterprise. Net profit is shown in the income statement, which is one of the financial statements. The business entity concept is one of the main accounting principles. The principle is that the business is separated from its owners. In other words, the business will not affect the owners, and the owners will definitely not affect the business. The activities of the business doesn't have anything to do with the owners. Assets, liabilities, income, and expenses of the company is different from the assets, liabilities, income, and expenses of the owners. One of the most common accounting equations is assets equals liabilities plus owner's equity, which is A equals L plus OE when abbreviated. Everything you learned and lose will be recorded in a general ledger, which is also known as a T account. When you record in a general ledger, whenever there is a transaction, the account that was debited and credited will be both documented. Therefore, the credits will be the liabilities and the debit will be the assets. The amount of assets and liabilities should equal. Here are a list of transactions for Mr. Lee's garage. According to this, we are going to make a general journal. I will explain fill of the transactions. The second transaction states that collected Si Huang 1,000 cash for payment on account. So I debited bank 1,000 and credited accounts payable Si Huang 1,000 because at first Si Huang owes the company $1,000 and now the transaction states that $1,000 is being collected from Si Huang, which means that Si Huang had paid back of what he owed to the company. Therefore, 1,000 is being debited in the bank because money is received from Si Huang. The next example that I'm going to talk about is the third transaction, which is on the 10th of March. It states purchased 8,000 car parts from Gloria's Auto, $4,000 cash, and the remaining on the account. Accounts payable Gloria's Auto is debited $8,000 because the company bought car parts from Gloria's Auto, and now we owe the company money. The second part to that transaction says that $4,000 is paid in cash, which refers to the bank, so we credit the bank $4,000, and it also says that the leftover of the money is on account, so we credited Mr. Lee's capital, so that the amount on Mr. Lee's capital and the bank will balance with the money we debited in Gloria's Auto. And this is the last transaction, which was issued on 24th of March. General journal descriptions are located on the last row for each transaction. This description is a short statement where it summarizes what happened in that transaction according to what is being debited and credited. One example would be the first transaction. It debited the account payable and credited the bank, which usually means that the account's money being owed to the company increased, so we debit it and bank will be credited because the company gave money to Gloria's Auto, the company's account payable. This is the general journal, which is recorded in chronological order. There are usually 4 parts to each journal, which is the date, debit, credit, and the description after each transaction to summarize that specific transaction. The first transaction of the journal needs to include the year, month, and day, but the next transactions only need the day, unless it went onto the next month or it went to the next year. Notice there are some errors on this journal. The first transaction debited account receivable A. Lee and credited account payable K. Lee. The date of this transaction is correct, and the location of the debit and credit is also correct, where debit amount is stated before the credit amount. The description stated it performed service on account, which debits in the account receivable is reasonable, because A. Lee paid the company $400 for the service. However, the credit account is incorrect, because when a service is performed, fees earned should be credited, because now the accounts receivable A. Lee owes the company $400. The second error made is in the second transaction. The date is correct, where it is stated only the day instead of the month and the year. And the order of the debit and credit is also correct, where the debit is in front of the credit. The description is G. Lee withdrew cash from the business. Therefore, the accounts of debit and credit is incorrect, because when the cash is withdrew, the account G. Lee drawings should be debited, because more money is being owed to the company. Also, when money is owed to the company, because cash is withdrew, so the bank will be credited. So we just switch the debit and credit accounts for the second transaction. This is a transaction, and below is a general journal. According to the transaction says, on May 3rd, 2011, G. Lee withdrew $5,000 from the business. Therefore, we debited $5,000 in G. Lee drawings because more money is owed to the business, and also G. Lee took out $5,000 from the business, so the money in the bank will decrease. However, there are some changes made to this transaction, where G. Lee only wanted to withdraw $500, but he withdrew $5,000. In order to fix this, $4,500 will be debited on the bank, because 5,000 minus 500 is 4,500, and G. Lee wanted to put back 4,500, so only 500 will be withdrawn. As a result, the account G. Lee drawing will be credited because 4,500 is put back in the bank, so the money that G. Lee owed to the company is decreased. This is a trial balance, which is the total of accounts of debit and credit balance equals. It is mainly used to detect if debit and credit equals in the total and see if any errors are made. If the debit and credit doesn't equal, this shows that there are some errors made in between. To calculate the trial balance is the sum of all the balances of all the accounts. Here are a list of accounts, and you will have to create a financial statement. The financial statement is going to be created for all these revenues and expenses is an income statement, which is the form of financial statement which focuses on your revenues and expenses, as I have mentioned previously, and the numbers beside each account is the amount for each revenue and expense. Here is the income statement created according to the previous slide on the accounts. You can see that the revenues are listed at the top before the expenses, and the amount for the revenues are listed in the third column, and the amount for the expenses are all listed in the second column, except for the total expense that is calculated by adding up all the expenses on the right column, under the total revenue number. Lastly, the bottom line for the income statement is the net profit, or net income, where you subtract the total revenue to the total expenses will be double underlined. Here is the challenge question, where I listed the assets and liabilities and equity of the Gavin's Cantonese School and Jody Salon. The values shown is not necessarily the values I can get, because there might be shareholders and each shareholder has different amount of proportion of the business, so the values shown might not be the value you will get. I think that there wouldn't be any problems associated with the selling of the assets. Also, I think that Jody's Salon will be better to own because I think that the land and building is the most important out of these, because if you have land, you can do more events or activities within your business. And when you find a percentage of land to the total of assets for both businesses, Jody's Salon has more land than Gavin's Cantonese School. In this podcast, it went over a few of the main concepts: financial statement, which are the income statement, balance sheet, and cash flow statement. The account relationships between net income, equity, revenues, assets, liabilities, and expenses. We also looked at the net profit, also known as the net income, business entity concept, general journal, and lastly, the trial balance. And this concludes to this podcast. Thank you for listening.